Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. I'm your host, Dylan Silver, and today on the show we have Jon Kutsmeda, mortgage expert, 20 years experience, and tech founder of lenzen.com. Jon, welcome to the show.
Great short little intro there, Dylan. I appreciate it, and thanks for having me on.
Absolutely, absolutely. Before we were hopping on here, I said, typically there's one format for the show, but we might nerd out a little bit here, on my end at least, and get into some of the weeds about the mortgage space, which I'm an agent in Texas, newly licensed agent. I'm also work with a lot of investors, and I have a background as a wholesaler. I think innovation, specifically in the mortgage space, has seemed almost painstakingly slow.
Agreed. And agreed. A lot of that comes down to the way the industry is structured and the incumbents and how much power they have. If it's serving you and you're one of the most powerful in the industry, why would you want change?
Yeah, I mean, it's from my vantage point and looking at Lenzen and what is offered, people have to go through all this red tape, and it puts them in a position where, much like some other large purchases, it becomes, I'm just tired of shopping, let's get this over with. And you don't want that to be a factor. You don't want retail fatigue to be the greatest driving factor for when you decide to pick, a mortgage or a home or anything that's this critical. And so briefly, to folks who aren't familiar with what Lenzen does, what is Lenzen and what makes it unique?
Yeah, I think I'm going to use your term there more frequently. The retail fatigue has really been at the forefront of mortgage companies and their sales strategies, because what a lot of people need to understand, and is really behind the basis for Lenzen, is that mortgage rates don't actually change. They're not rising or falling. And this has to do with the fact that banks and lenders individually aren't deciding what rate to offer you. It's determined by the bond market, mortgage-backed securities, and what price that those things are trading at on a given day. And so what ends up happening is interest rates aren't the things that are moving here. It's the price of each individual rate. So a lot of times you hear today's rate is 7 1/8 or 6 1/2. That's an inaccuracy. And what it's trying to do is blend together what different banks and lenders are charging for a particular rate and kind of give people a sense of what the range of what they would see if they went out shopping. And I think it's a really huge disservice, because what ends up going into it is this retail fatigue. And what people end up doing is they go out there, they're looking for different quotes. One company might give them a 6 1/2, another might give them a 6 1/4, but that's apples to oranges. What ultimately consumers need to be doing is comparing the same rate, say a 6 1/2 to a 6 1/2 on the same day, and looking purely at what that loan is going to cost them with each institution. Technically today, if you wanted a 3.5%, 30-year fixed mortgage, It's trading. Those mortgage-backed securities are trading. It's just the price at which they're trading is so illiquid. What the consumer would need to pay out of pocket, a lot of times people refer to that as points, what is actually called discount fees. But the cost to get that rate is so ridiculous that you're not seeing it promoted or offered. So it's not that interest rates aren't 3.5%. It's that the cost to get that rate is so ridiculous that it's not part of the marketing or sales narrative. So what consumers actually need to realize, number one, is that all rates are centralized. They come down to what mortgage bonds are trading at today. And so everyone's going to offer you or be able to offer you the same exact rates. You're not shopping for rate. You're shopping for the cost of a rate on a given day, same, apples to apples. And so what LensN has done is we basically democratized that interest rate information from a cost perspective standpoint. So you can see all rates that are generally in the footprint of what is affordable or economical for consumers, and the cost of each one of those interest rates in real time without any contact information. Most people who've tried to shop for a mortgage are probably used to going to a website, being promised something on the website, like get an instant rate quote. You go through 10 or so questions and you get to the end, and it's a lead magnet, right? They want you to give them phone and email information before they give you anything. You put in your contact info, you still don't get a rate quote, and all you end up doing is getting a lot of phone calls and sales pitches. So we understood that pain point significantly. In the same way some of these websites like the Zillows of the world have democratized listing info, we've democratized that interest rate info. So you can go through the entire shopping process, do all of your analysis, all of your comparisons, which honestly LensN does automatically for you anyway. But we give you all that info up front without any contact details. There's no bait and switch. There's no forms you have to fill out where we can then, reach out to you. I think we are very confident that by creating this automation, we've been able to compress our margins to be able to operate in the space. So we want people to see our pricing. We want to see how much more competitive we are versus other companies. And I think the last couple years, with the way interest rates have risen, home affordability has become such a hot topic. Consumers have gotten really, really savvy in terms of how to shop for a mortgage. The retail fatigue is still there, but I think people are now forced into a situation where they have to push through the fatigue and actually hunt for more cost-effective options because it's the only way they can afford to buy a home. And if your lender is sponsoring a sports arena and sponsoring commercials during the Super Bowl, chances are you're getting hosed on the mortgage because the only way they're paying for that is basically by charging you more on the same rate you can get elsewhere for much less.
Let's talk about that. Maybe a 101 here. So for people who are maybe looking at getting their first home, right? And they're hearing 6.5% is not the same as a 6.5% at one other place, because they're paying for the fees associated with that 6.5%. In their minds, hearing this, they're saying, wait, I thought if 6.5 is 6.5, how is this any different? So the company the mortgage company is effectively paying one type of fee to originate this loan, which is then passed on to the consumer. Am I getting that right? Or am I butchering it completely?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
No, I mean, I think it's the premise is there. So I think we can break it down a little differently and start with how the bond market works, which investors are buying into these bundles of mortgages. I think most people are somewhat familiar with that concept, either being around during the great financial crisis or watching the movie The Big Short a few times. But those mortgage bonds trade in 0.5% increments. So let's say a mortgage bond is a 5.5% or 5% or 4.5%. What actually ends up going into those mortgage bundles are note rates or mortgages with an agreement for an interest rate that is slightly higher than that coupon rate. So I'll give you an example so people can visualize this. Let's say you have anywhere between a 5.75 to somewhere around a 6 to 6.1. Very, very likely those mortgage rate loans with those mortgage rates are going to go bundled into a 5.5% coupon. And the reason is because there's a company in between the bond investors, who the consumer never has any real communication or relationship with, and the company collecting your payment, the servicer. They collect the spread. So the whole industry has become about spreads and servicing. So whether you have a 5.75 or 5.25 or 4.25, depending on what that mortgage note rate is, will dictate ultimately what bond security gets packaged into. But it doesn't change the fact that the servicer is only going to make 0.25% to 75 basis points in terms of the servicing spread. So the incentives here are hugely unaligned, right? Because the mortgage companies that work in both origination and servicing, a lot of these big name mortgage banks, they don't care how bad your decision is in terms of interest rate. Like if you overpay today to get a lower rate, it's actually better for them because the chances of you refinancing that rate are so much lower that they get to sit there and collect that 25 to 75 basis point servicing spread so much longer. So there's a huge misalignment of interest, number one. But ultimately what it comes down to, what you pay as a consumer depends on what the bond market is willing to pay at that coupon. Say 5.5% is trading at, $1 to $1, then any interest rate that's going to be put into that security is going to come with a certain amount of cost. Now, as more and more money flows into the bond market for any number of reasons, usually there's some sort of crisis or risk off event that cause investors to want to have more bonds in their portfolio. More money will flow into these mortgage securities. And that 5.5% coupon is no longer trading at par, dollar for dollar. There's now a premium rolled into it. And so a 5.5 might be trading at 102 or 103. There's a percentage of premium on top of that the bond investor's paying to get $1 of income back. That premium is ultimately what gets passed on to the consumer if you're dealing with a company like LendZen, which is really thin on operational cost and margin, or it's what the lender puts in their pocket to fatten up their profits. That's really what the customer is shopping around, is how well does one lender versus the other navigate or use that liquidity or those rebates to make the cost of getting a loan cheaper for the borrower. And a lot of consumers hear, oh, I have to pay 1 point, 2 point, 3 points, whatever it is to get a loan. That can be very ambiguous language. What it really comes down to, if you're shopping for a mortgage, so I can summarize this simply for everybody, is you need to compare same rate on the same day and only look at the cost of getting that loan, because everyone's sending the loan to the same place at the same price. It's what that company is able to do with that price or those margins dictates what the customer is ultimately getting at the closing table.
Really simple question here, John. When you were saying cost, that's money down?
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Cost would be, in terms of getting the mortgage, it would be the fees that you would pay. So every company is going to have their operating margins. Let's keep it really simple with the math. Let's say you have a $100,000 mortgage, right? And today's par rate, meaning there's no rebate being paid to you,
right,
and there's no points you have to pay to get that rate. Let's say that par rate is 6.5%. Okay, if you go to LendZen, we might charge an aggregate 2 points between what we charge in origination and the escrow fees, title insurance, everything else. All those third-party fees are the same no matter where you go. But what you're really looking at is, if you take that par rate and say with LensEnd it's 2 points, and you go to say another company, a local bank or Rocket Mortgage or whatever it is, and they're charging 4 or 5 points to close that
Yeah.
deal, that's the cost that people need to consider. It's honestly just the aggregate total. Instead of getting caught
Okay.
like wrapped up in the language, which oftentimes is ambiguous, like, oh, here's a 6.7 with no points, and it's like, okay, well, what's your 6.5? Because I already have a 6.5. Like, let's compare apples to apples so the consumer always knows in aggregate, if one loan's costing me 10 grand and the other loan's costing me 6 grand, it's a really simple, equation at that point.
Do you feel like, John, I mean, just hearing this, I'm an agent myself, new agent. I got licensed last week, but I've been active in real estate for a year and a half, and just being around, I've heard these terms, right? But if I'm not active in real estate, if I'm totally new to this, that when I'm going through this process, not with a lens end, that this can be extremely confusing for some people. Is there kind of a level of this where it's like big mortgage, understands this and expects that people aren't looking into it this granularly?
Look, Dylan, I love the way you're approaching this conversation and the questions you're bringing up, because it is 100% highlighting kind of the intellectual arbitrage that the industry has been playing for 20 years. The more ignorant and dumb they can keep people in terms of how the industry functions, it gives them the capacity to continue to exist, especially when they're not competitive, because the retail fatigue is very, very real. And the confusion and the lack of understanding creates intimidation. And so there's this natural default to, well, it's my local bank, or, well, I see this company everywhere, so I must be able to trust them. And they use that without a doubt to their advantage to take advantage of customers who don't actually know. That's why I really emphasize frequently same rate, same day, use an official loan estimate disclosure, no fees worksheet crap that people will put together to kind of try to make their deal look better. If you aren't comparing same rate, same day, I can't even tell you who's the better deal or the more competitive offer. And that's one of the reasons LensEnd is showing rates and all of our fees and pricing in real time. Because take, for example, this week, this is one of the worst weeks ever in the history of the US bond market, especially in mortgage-backed securities. Friday, the 10-year treasury was in the 3% handle. So you had like 3.9, 3.8 range that the 10-year was hitting. The 10-year is now 4.5%. It's a 60 basis point move in 4 or 5 days. The mortgage-backed securities market sold off even harder. So what that really means is the rate quotes you were getting on Friday, not only are they worthless, but they've been completely blown out of the water, because that same interest rate you were looking at then is significantly more expensive today. And I have to reemphasize that. Interest rates and mortgages haven't changed. The rates don't move. It's the cost of the rates that have changed. So the 6.5% or 6.25%, whatever you were looking at on Friday, is easily 200 to 250 basis points, if not more expensive today. So on a $500,000 mortgage, that same rate is now anywhere between $10,000 to $15,000 more expensive.
Okay. Wow. Okay. So backing up a bit here, John, you mentioned two types of ways that people can see fees. One was a loan estimate disclosure and one was not. What was the one that was not that?
So there's an old form that this was pre-Dodd-Frank, that, this was the 2008, 2009 era. There used to be what was called a good faith estimate. And what they would ultimately use after Dodd-Frank, because the old good faith estimate got reworked, but the old good faith estimate layout was converted in what's called a fees worksheet. And the reason regulators got rid of that old GFE is because it was notorious for lack of transparency. And, the 2008, 2009 mortgage world loved to finance huge costs into the loan because, of course, back then, home prices were only going to go up. And so people were doing these ARM loans. A lot of times they had prepayment penalties, and they would just continually refinance, roll the prepayment penalty into the loan. And so that old fees worksheet did a really good job of obscuring those costs. And so it was kind of pushed away and made no longer valid as a legitimate disclosure. We still see that form float around all the time as an upfront way to show people, hey, this is what this lender is offering you. And it's just it's horribly unclear. It's also unbinding. And that's another reason why a lot of companies try to use it, is because if they put forth a loan estimate, you can use what's called a pro forma loan estimate or a loan estimate draft. And for the lender's case, it's less binding and there's less compliance issues there, but it's still just an incredibly higher level of transparency versus any other form. That the fees worksheet's a popular one, but a lot of lending companies, especially banks, will create their own, what looks like a spreadsheet on fancy letterhead. And it's just a waste of time for the consumer to even look at that, because there's just no way. Again, you get into this apples and oranges thing where they're not armed with enough information or experience to be able to make sense of that. But if they compare a loan estimate to a loan estimate, same rate, same day, there's only one number they have to look at, and that's the aggregate cost. And so that's why I emphasize that heavily.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Let's talk as far as chronologically. When people are going through this process, they submit a loan application, right? Let's say they make enough income. I've heard this colloquially, 3 times after your available money, 3 times the mortgage payment. They have good enough credit. What should be a reasonable time frame? Is it instant with most of these other institutions, or does it take several days for them to get a loan estimate officially back to them?
Yeah, I mean, I think that timetable is a part of the problem, because what's the point of getting an estimate, even if it's a 1-day turnaround or a 2-day turnaround, if interest rates are changing every millisecond? But generally, yes, you're going to go through some sort of process. It's different everywhere. With Lenzen, what we've done is, if you go through the customization process and build your own loan scenario, at the very end, we have a summary page which shows you all rates. It's real time. There's a slider you can use to change rate and see how the payment and cost of that rate changes. But we also show you the maximum qualified loan amount. And that's based off of the income parameters that you've put in. So that's kind of like a soft pre-qualification. So at real time, we're giving people a sense of where they sit if their initial goal is, how much can I afford? Do we want to, dive deeper into that? Should people be pursuing a pre-approval so they know exactly how much to the penny they can afford, which requires us to run their information through various algorithms, what we call in the industry automated underwriting systems. Fannie Mae has one called Desktop Underwriter. Yeah, they should be pursuing a pre-approval. But I think a lot of that creates the retail fatigue we're talking about. Yeah. And what a lot of people like to do in the industry is try to create momentum, right? Like, well, if I get somebody to apply, I pull their credit, they start uploading documents, they're already fatigued, right? And they don't want to go shopping again under the impression they're going to have to do all that heavy lifting just to kind of get a sense of whether there's another competitive option. So I think generally up front, they should be focused more on pricing and finding not only a trusted resource, but the most competitive options, and then go into those more granular, how much can I approve to the dollar? And what we've also done in that regards is, once we do a full pre-approval with somebody, we issue access to, and it's on the very bottom of our homepage, a pre-approval letter dashboard. So once someone's pre-approved with us, they don't have to come back to us and request pre-approval letters that they submit with their offers, which is another huge drag in the industry. Yeah. You got to go to your loan officer. Hey, I want to submit an offer for $425,700. Okay, let me get my processor to write up that, pre-approval letter for you. our system allows people to issue those letters up to their maximum qualified amount instantly. The seller can then also click a link on that letter, which authenticates whether that letter is real and still active. So we've kind of eliminated that whole intermediary process where the seller's like, can I trust this buyer? Oh, I need to get on the phone with the loan officer, and it's a bunch of subjective conversations. Bottom line is the letter good? And we authenticate that in a few seconds. So I think borrowers, to answer your question specifically, need to start with the price comparisons, and you don't need to do a full application to start doing that process. You can tell somebody, hey, give me an estimate for $400,000 at this given interest rate, assuming I have 800 plus credit. All of that's going to change the same for everybody. If your score isn't 800 and it's 680, well, it's going to have the same matrix style impact on what that interest rate costs you, no matter where you go. So I think there's two steps to the process. One is, who should I be working with based on how competitive their pricing is? And then determining what my highest potential offer price could be with a full pre-approval. But in the interim, if someone's just kicking tires and wants to know generally, can I afford this home or not? We provide that calculation instantly on LensEnd. And again, we're not collecting any contact info. There's no need to sign up or sign in to get that insight.
Wow, very interesting. Pivoting a bit here, before we hopped on, you mentioned something. I said I want to say this for the podcast. You talk about Fannie Mae and Freddie Mac getting out of conservatorship. People who are applying for loans are going to hear these terms and may not be familiar. My understanding is that these are, I forget what the term is, but established by Congress, but also for-profit companies that are overseen in some way by Congress. But you mentioned getting out of conservatorship. So I'm curious what your perspective is, and how did I do explaining that?
No, it was a good job. I mean, these are what are called government-sponsored enterprises or entities. And there was an implicit guarantee that very quickly became an explicit guarantee when the GFC happened and the subprime bubble burst and the government came in and bailed out these institutions. They still owe the government hundreds of billions of dollars. And they're currently making the government a pretty good coupon every month in terms of the income that's coming in. If they took them out of conservatorship and made the risk of those entities public, you're going to immediately see a change in interest rates. Again, interest rates don't rise or fall. The price changes, but the risk associated with now there's no government backstop would mean interest rates are going to get much more expensive. That's one reason why I don't think, number one, it helps the situation in the US in terms of housing affordability. But yeah. I think more specifically is some of the actions that we are seeing that potentially are leading towards that goal. Whether they achieve that goal or not because of both political will and economic impact, someone else can debate that. But some of the things that they're doing to try to shore up confidence in Fannie and Freddie is you've seen a really big shift away from non-owner occupied properties or investment properties. The way they've always done that, again, is not that interest rates are changed. It's just they apply a risk-based or loan level price adjustment. So if your 6.5% first-time home buyer primary residence mortgage is going to cost $1,000, that investment loan might cost you $5,000, right? There's an impact to the cost of that loan or the premiums associated with it, which is really just a risk adjustment. So what they've done is massively increased that risk-based adjustment to the point where doing a non-owner occupied or investment loan based on these GSE agency guidelines has become very unattractive and uneconomical. And so in a good way, what that's created is a new secondary market that's more private capital coming in to kind of service those loans. And what you're actually seeing, and you'll see this real time on LensEnd if you go in and price it out, is this private market in a lot of cases is actually pricing better, substantially better than what you can get with a agency loan or conforming investment property loan. And a great example, as we were talking about, is the ability to do a cash flow only loan. So investors are all driven by the numbers, or they should be, right? You should be making a property investment based on whether that's going to generate cash flow. Well, there's a loan called the DSCR loan, which stands for debt service coverage ratio, which is an analysis frequently used in commercial financing, but more and more so the buy and hold cash flow investors are focusing on that heavily. So as long as the property cash flows net positive, you're approved. There's no other income qualifications. And so it's incredibly attractive if you're somebody who, has a really ugly tax return because your entire income is based off of cash flow. Or, hey, maybe you're in the gig economy or whatever it might be. The income challenges have been real for people who aren't W-2 basic tax return borrowers, especially for investment properties. I think the cash flow DSCR type of opportunity solves that significantly, and it prices better than if someone was qualifying based on their income for a Fannie or agency style mortgage that's for an investment property. And you don't always have to cash flow positive. You can go negative cash flow and still get the DSCR loan. Obviously, it's riskier, so it just means the cost of that loan or the cost of a given interest rate is going to go up. But you can see that real time. If you go to LensN, you click start, say it's a purchase, you click purchase. The next question is going to be, what's my income profile or income type? And the last one says cash flow. If you click that, it's immediately going to show you all available programs and the lowest rates available for those. You can click any of those program thumbnails, and it's going to ask you, do you want to customize, which is what somebody should do who wants to get very, very specific. But if you just want to see a default scenario and see how it all lays out, you can then click the button that says review all rates, sends you right to the summary page, gives you all interest rates, all costs for those rates, and the same analysis you would get if you customize. So in a few quick clicks, you can see how the DSCR loan stacks up. And then whether you open up a new tab and do one that's conventional standard investment property, or on that same exact summary page on the bottom, you can modify your inputs and change it to a normal style investment property right there on that page, and that will open up in a new tab so you can do side-by-side comparisons. But the DSCR loan is very attractive, and a big part of why it's making more sense today is that I think these GSEs are hoping at some point they can get out of conservatorship, and reducing the risk of their portfolio is a big step.
I think that being able to qualify when you have, not just straight up W-2 income can seem like a giant hurdle. People talking about, having different strategies and different creative ways to buy homes. But knowing that there is a resource for them, people can go to a LensN and qualify based off, DSCR, like you were speaking about. This is the first time that I've heard this, right? And I've had how many investors on the show. I think, although it is known and people are out there, when folks are hearing it right now, it may pique their interest, realizing, hey, I didn't realize that I could qualify through a, online, bank based off of my income or how much the property is cash flowing, when my income might show based on my tax return that, last year it was a wash.
Yeah. And those loans are also applicable to short-term vacation rental income. That's a different type of risk. So there's a slight price adjustment when you are looking for a loan that you're going to qualify for using short-term vacation rental income, but it's still an option. And I think the best way I can put it is, if you have liquidity and long-term, you think there's going to be the same trend in dollar weakness and inflation that we've seen for the last 50 years, securing not only assets that they're going to appreciate against that, but in the meantime, pay you an income stream is a no-brainer strategy. And I think a lot of people have liquidity, have cash flow, and the most beautiful part about real estate is the leverage. And for so many people who have the cash flow but not the income, have the liquidity but not the income, haven't been able to take advantage of the power of leverage with real estate, and now they can. So anyone who's looking to, build a portfolio, and cash flow is a core part of their analysis, now they have the leverage opportunity to finally get into the market.
John, we are coming up on time here, although I think I could pick your brain here selfishly about all the topics in this space. We haven't even delved as deep as we could into different ways that this could expand in the future. No one has a crystal ball here, of course. Would love to have you back on here. But, John, where can folks go to get a hold of you?
Yeah, Dylan, again, really great questions. I appreciate you and your audience giving me a chance to tease at them in a very granular way. I'm pretty easy to find everywhere. The handle is first name, last name. So it's Jon Kutsmeda, no H in my name. So it's JON KUT as in Tango, S as in Sierra, M as in Michael, E as in Echo, D as in Delta, A as in Alpha. So I'm everywhere from Twitter to YouTube to Instagram. I probably communicate the most openly and frequently on Twitter, or what is now X.
John, thank you for coming on the show.
Dylan, thank you. I really appreciate it.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.